So today's Lunch and Learn is about the relationship between real estate and mortgage. And I'm excited to dive into the topic. And I see that we still have some people dropping in, but we do have a lot of content. So I'm going to start with introductions. My name is Allison LaForgia. I'm the Senior Webinar and Events Manager at HW Media. And today I'm joined by a really great panel, and I'm excited for everyone to be able to hear the insights that they have about this topic. First, we have Charles Williams, who is the CEO and founder at Percy.
Hey, Allison, thanks for having me.
Yeah. And we also have Josh Metal, who is the Division President and Director of Physician Lending at Neo Home Loans.
Hey team, great to be here with y'all.
And we have Shashank Shakar, who's the founder and CEO of InstaMortgage.
Looking forward to it.
All right. So with that, the idea behind today's Lunch and Learn is to talk about how in the last few years, we've seen the word disruptor often. And for professionals in housing, there have been a few companies who've been really able to live up to that idea of disruption or true disruption. Instead, we've seen a lot of innovation through partnerships, M&A, and other activity. One of the trends we really want to zero in on in this conversation is the idea of innovation through partnerships, specifically the partnership between real estate and mortgage. There's been a lot of topics and a lot of articles recently about where the housing industry is at. And one of the things that we wanted to do in this panel is to really talk about looking back on the idea of the relationship between real estate and mortgage as we are in this purchase market for the foreseeable future. So the first question that I had is starting with a really zoomed out view and why this is a conversation that we should be having with the market as it is. And Shashank, I want to start with you.
Sure. Allison, as you mentioned, the fact that we have seen a lot of JVs come through, or companies who are on the real estate side trying to be on the mortgage space, or on the mortgage side and trying to be in real estate. I think that all started almost about 4 or 5 years back. We saw that Rocket started with Rocket Homes, Keller started with Keller Mortgage. Loan Depot has its real estate company. Better started with having the Better Real Estate or Better Homes. So we have seen that happening for the last 4, 5, 6 years. I think the big philosophy that the executives or the company leadership is thinking is that, look, home ownership in its full form is one journey. It's what has happened so far is that real estate does its part and then mortgages does its part. And they're not too happy with the experience that happens when the transition happens. So they believe that they are the better part of it. So say, for example, if Rocket thinks they do an amazing job of doing mortgages, they want the same experience for real estate, and vice versa. If Keller thinks that they do an amazing job of the real estate part, they want the same kind of experience to happen with mortgages. And that's what's lacking. So what they are trying to do from whether it's JV perspective or M&A or starting their own mortgage space is to have the same homeownership experience wing to wing. So you don't have that disconnect when the handoff happens between real estate and mortgages. But even for the industry as a whole, I think it's really important for us to understand that whether you run the same company or not, whether both the companies are part of your organization or not, it's the most intricate connection or partnership that exists within the overall real estate industry, the real estate and mortgages. One does not work without the other. And so it's really important, especially in a market like 2022, when we know that the refinance is almost gone from where it was, especially in the last 2 years, is that both the industries work together, whether it's through JVs, whether it's just simply loan officer, realtor referral partnerships that we can talk about. But really, that's the way forward for the next 24, 36 months, is to build that relationship strongly, whether you build that under one umbrella or whether you keep it separate, but you keep that referral relationship between the two. But that's where I think the industry has been over the last few years. That's the philosophy, or that's the viewpoint that the executives are thinking. And in my opinion, both as being a loan officer and the CEO of a mortgage company, I mean, that's where we need to be heading in terms of partnerships.
Chuck, I see you nodding in the background. I want to give you the opportunity to jump in.
Yeah, sure. No worries. I'm nodding partly because of what Shashank is saying, but also because my son just walked in the room and traditional Zoom in today's world, that's what happens, right? But no, I agree with everything that was just mentioned. We come from a place where a lot of our clients are large brokerages in the real estate space where they do have those relationships that Shashank just kind of mentioned. And I think really during the pandemic, it really sort of kind of exposed how important that relationship is. So like during the boom, right, we had, yes, increased revenues, but also the cost of doing business was dramatically increased. And now that revenues on the downslope in some segments, the cost of business is still there, and you're starting to see those changes. And so while we, yes, had the record volumes during the pandemic, a number of loans fell out, and now we're shifting to sort of this purchase market. And I think, again, that highlights the importance of that mortgage to real estate relationship being tightened more than just called the buying donuts challenge, where a lot of times these lenders will buy donuts and coffee to try to help increase their relationship. But I think it's more about the relationship between how real estate really fuels new purchase business in the mortgage space, right? New housing transactions equals new borrowers. But one of the stats that I tend to help educate our client base on is there's a stat by National Association of Realtors that says 7 out of 10 buyers own a home currently. So they're really not new borrowers, they're repeat borrowers. And so I think having a strong relationship with your real estate partner, those are the ones that have the relationship with the homeowner, the future borrower. And, they're doing client for life initiatives. They're doing staying in contact with those past clients with relevant information. So again, I think now that the market's kind of spinning back, it's really important to have and empower your real estate partners to generate new listing inventory because ultimately that's going to increase your odds of recapturing that repeat borrower. So that's kind of how I see the relationships and how it is in this current dynamic.
I would just add that I'm not sure that this concept has really been fully tested in that we have mortgage and real estate and we have them married together. And the concept is that this is going to create a better client experience. And I'm not 100% sure I'm sold on that. I think it's possible that we can get there via technology and training. But as of this moment, I don't believe that fact to be true, that the same company owned or joint realtor and mortgage is actually a better service for the customer. I do think that the real estate firms of the world, the big real estate firms, realize that there's a lot of margin in mortgage as they believe in title and that they want to have an additional revenue stream. But what I've seen is when somebody is, let's take a loan officer who's inside a realtor's office. After a while, they feel this like it's incumbent that they're going to get these leads, and they don't have to be quite as competitive. They don't have to drive the same amount of value. They don't have to be as entrepreneurial. They don't have to be as creative in coaching and teaching the client because they have their spot at the trough, if you will, and you're going to get the lead from that realtor office. And I know that, that's not always true, but I have seen some of the real estate firms that have JV'd with mortgage have a real hard time keeping the realtors satisfied at the performance that the loan officer's done. And I have to believe that a lot of the owners of those JVs specifically right now are not all that happy with the economic returns. So it'll be interesting to see. I think there's still tests ahead of that model.
And Josh, and that kind of explains the capture rate in single digits, even for captive mortgage companies and real estate offices, is because what you're saying. So what I was explaining is what the philosophy is from an executive perspective, but we really don't see that playing out well in the field, because if that was the case, then the capture rate would be significantly high in double digits, and we don't see that.
Yeah, I think you laid it out beautifully.
Right. So I think the idea going off of capture rates and kind of looking at the why behind this conversation, I want to take 2 steps back, I guess, and say when we look at today's market and we see all of those terms that are currently in headlines like recession and low inventory and margin compression, I think each one, with the exception of recession, just got tossed out there. I want to ask, is there sort of a silver lining moment to that? And Josh, let's start with you.
Well, so my first day in the mortgage business was September 11th, 2001. So I started in the middle of a crisis. And a few years later, we saw 2006 and there was another crisis. And so now looking back over 22 years, there's always, I guess 21 years, excuse me, there's always some sort of headline or something that is eliciting fear in the market. And I've described this as, I think there's a lot of darkness in the mortgage world right now. There's a lot of doom and gloom. There's a lot of originators who are feeling paralyzed, I think is the right word, because of these things that you're mentioning and all of the headline news. And they really don't know how to counter that narrative really intelligently with the consumer. And so when I look at all of those problems, I look at it as an entrepreneur. Hey, problems equal opportunities, because I have an opportunity to solve that problem. And if I can do that faster and better than somebody else, then I get a catapult forward during these times rather than being paralyzed. So I think that we have to look back over our careers and realize that through the setbacks that I mentioned, or the really scary times that I mentioned, I believe it's true. Most of the successful folks in our industry actually made a pivot at that time that catapulted them forward at the next kind of top of the business cycle. They wouldn't have got to that next peak had they not traveled through the valley. So I think that what I would say is that it's incumbent on us as leaders to continue to bring the realities of where we are, but also the light into the future, and to continue to remind our teams that this too shall pass. And here's the opportunities that this situation is creating, and charge. Let's go. Like, we've got a lot of people out there to help. And in the meantime, let's figure out where the opportunities lie.
Chuck, I know you have an interesting perspective on this, and there's some exciting things you have in the works. So I want to make sure we we pivot off of this.
Yeah, I mean, kind of like Josh is saying, I mean, it came right, like everything to us is a silver lining. Like, this is silver lining for us, because the mortgage companies, the real estate brokerage companies, the ones that are strong and did see this coming, they prepare for it and they double down, they invest, they become more efficient, especially with the data that they have available to them. And so this is really what separates the strong getting stronger from the weak falling off all completely. And so this is all the silver lining for us from our perspective. We're here to help those that see that as an opportunity to double down, especially on technology, especially on leveraging their data, especially becoming more operationally efficient with what they already have. So that when, as Josh said, as you come out of the valley, the next peak, it's not going to be a peak, it's going to be a mountain peak, not a hill peak. So anyway, that's really how we see it. So thanks for chiming in.
I think we need to also test our benchmarks a little bit here. I mean, if you are coming off of 2 years of $2 trillion of $4 trillion of origination each, and you're saying a year like $2 trillion, which is where we are expected to be this year, or 1.7, 1.8, wherever we end up, is a bad year, then go back to the last 10, 15 years of mortgage originations. There have been multiple years of $1.6, $1.7 trillion origination. So if you look in isolation, 2022 is actually a very strong year for mortgages, especially for purchase mortgages, because we'll end up with over $1.5 trillion in origination, which is one of the best years that we'll have. So I think we have this recency bias of the fact that we are comparing 2022 with two very abnormal years, so to say, and same Same with housing pricing. I mean, you talked about housing recession, but we had a 16.9% appreciation rate last year. If you do year-on-year comparison, it will go down. I mean, this is just bound to happen. You look at economy, we grew at over 6% in 3 of the 4 quarters last year. Again, if you do year-on-year comparison, we will be down compared to last year. So the problem is more in the benchmarking than in looking at the numbers in isolation itself. Because if 2022 was 2019, we'll be very happy with these numbers, let me tell you. It's the fact that we are coming off of 2 years, which is untenable and unsustainable, and we are trying to compare 2022 with those numbers. So I think we, as an industry, as industry professionals, we need to kind of pivot our mindset to the fact that let's just look at 2022 the way it is versus trying to compare it with the last 2 years.
I think that's a really good thing to keep in mind. My next question was going to be, how would you, and it really comes nicely off of what you just said, what do you think people need to keep in mind in this cycle? I mean, there's been, like you said, explosive growth in the industry in the past 2 years. What do you think your statement would be to sort of address some of the apprehension that's in the industry right now?
Go back to basics. Go back to how you were. Josh mentioned it. Like, there have been tough years in the past. How did you get over that? Yeah. Because if you are a real estate professional or a loan officer who gets in the business when the things are well and then leaves the business when the things go bad, then I'm not talking to you anyway. And that's not a conversation worth having. But if you're someone who has endured some of that pain, who has gone through those rough times in the past, see how did you get over that? Whether you're in the real estate business or in the mortgage, you will see that most of the time when we get to a year like this, it's the basics that gets us through. It's the fact that we started the conversation by talking about real estate and mortgage connection, right? That's what's really gets us through, is that in these times, real estate agents need to be working with loan officers, saying what kind of products are you bringing into the table that can help us get some of these offers accepted? How are you handling the affordability issue? How are you tackling the higher interest rates with, say, possibly seller buy downs? And ditto for the mortgage professionals, they need to go back and talk to these real estate agents, because they are having these problems in either getting their sellers to list the homes or getting the buyers to get qualified for those properties that they want to. And these are the conversations we did not have over the last 2 years, right? I mean, out of $4 trillion, if 3 is refinanced, then why do you need a real estate agent, or vice versa? Because the inventory was so low, there was hardly anything selling. So that's what we need to get back to. And we are already in month 8. I mean, we should have gotten back to doing this 9 months back. But if you're not, it's never too late, because we will stay in this market for at least another 1.5 years, 2 years. So I would say go back to basics. It's nothing that we can teach you that you have probably not heard before. It's more about doing that action, having that discipline, and building for a change, a long-term business plan, instead of thinking in 3 minutes I can get the next refinance and close it in the next 45 days and get my commission check.
So well said. Yeah, what was coming up for me was this quote that hopefully I don't butcher, but good times make weak people, and we need this cycle to happen where weak people then make hard times make strong people, and we have to get back to that place where we're going through a hard time, and we have to re-attain or relearn or re-put ourselves into discipline where we make ourselves strong people again. And as originators, as Shashank just said so eloquently, we forgot how we got started. I mean, I remember I had a rule that I would call 100 people before I went home at night, or I would get 3 handwritten applications, or I would wake up 3 people at night. And I did that 5 nights a week for 5 years. And then Saturday and Sunday, I'd go to at least a half a dozen to a dozen open houses. Rinse, repeat for 5 years. And the business then started to take off. But as I look around at the originators today, I don't see a lot of people dialing 100 leads from 5 o'clock until you wake up 3 people, or saying, I'm just not going to go home until I have 3 applications. I don't see a lot of originators out going to a dozen open houses every Saturday or Sunday. So we have to get back to that discipline level of what it means to create business on the street level. And as Shashank said so perfectly well, there's a lot of things that we know as mortgage advisors, that realtors don't have that information. They don't know how to use buy downs to make housing more affordable. They don't know the difference between a short-term and a long-term buy down. They don't understand how a seller, a buyer wants to offer on a property $50,000 less than what the seller is going to take. And they don't know how to bridge that gap through a concession to pay for a buy down. I mean, there's just a lot that we can do to help realtors and their knowledge of how to make this market work a lot better. But we got to get out on the street and knock those doors and have those conversations and get from, out from behind our social media posts sometimes, which are great, but we got to actually get out there knee to knee with people and help them solve problems.
Yeah, I'd echo both. So we, at least I do, I see, when I look fairly newer to the mortgage space, but I kind of see two different types or two segments, I guess you will. One would be order taker and one would be trusted advisor. Yeah. And from what the previous two gentlemen were just saying, Shashank and Josh, was about more, you could rest on being an order taker over the last couple of years. But I think those that have become the trusted sort of home wealth advisors, if you will, those are the ones, especially now's the time to sow your seeds. Even 9 months ago was probably the time, so that once things come back around and you've done a good job. But Josh, it took 5 years, it sounds like. Some people, different time periods. But I think the main thing here is to become that. We always like to say, you're not just a real estate broker. You're not just a mortgage broker. You're a knowledge broker. Yeah. And that's really what ones that are going to succeed is becoming that sort of knowledge broker of helping become that home wealth advisor, if you will, that are going to succeed. And they're the ones that are going to be looked upon, because especially internet and tech, you can go out and get fine answers and this and that, but somebody's got to distill it down. And that's the ones who are going to succeed, in my view.
Yeah. So with that, it sounds like going back to basics is really sort of the message here. And how would you go about those partnerships? And I know, Josh, we spoke about this a little bit, and I know Chuck is is going to be good to hop in this, but let's start with you, Josh, because you brought up a couple of really interesting points when we spoke earlier about this.
Sorry, tell me the question one more time.
Have you seen, what are some of the examples that you've seen out of this partnership and really having the opportunity to go and talk to realtors from at least an education perspective?
Yeah, well, whenever I'm approaching a partner, whether it be a realtor or another, referral partner, or be a prospect, a potential client, I'm always trying to think through what's the problem they're having right now. And if I can get inside their heads and identify with what their top one or two problems are, then it's so easy to have a conversation. And so, the conversations that we've been having with our referral partners, both new and old, especially as it relates to our realtor partners and builder partners, is we've been saying, what are you seeing out there as it relates to contract cancellations and price reductions? Is that becoming a challenge for you? We're starting to see with our clients, what's happening out there? And then once you can kind of cue in on what's their biggest challenges are, you go from being across the table to being on the same side of the table of them. One of my mentors is Craig Strent, who owns Apex Home Loans. And Craig always had this beautiful illustration where he said, when I used to sit down on the table with a borrower and I would explain the loan documents, he said, I'd always make an excuse to move my body around the other side of the table. So I was literally shoulder to shoulder with them on the same side of the table. And he said, that was something weird that was just kind of metaphorically, it changed the whole perspective, because now we're looking at things from the same direction. And I thought that was such a powerful imaging that I always tried to do that as well. And if you identify what your referral partner's problem is, you bring that up in conversation, you allow them to share with you. And then at that point, we just simply say, are you interested in getting together and talking about some strategies to make housing more affordable for your clients? Or are you interested in potentially some price reduction mitigation strategies to help you not reduce the price as much on your listings? But if you start in, I think, with a partner before you've really identified your problem, that's an uphill battle. Once you've identified their problem and you've shown empathy, and then you have the knowledge and experience to show authority and a solution, boy, that's a downhill battle. There's not much resistance there. So I would just say, let's figure out what our referral partners' challenges are. Let's figure out some real strategies. Let's listen to them, and then let's go out there and help them overcome those.
Charles, I want to, going a step further off of what Josh just said, there's a lot of data out there right now. And how does data help us get there instead of this old, really complicated view where you're looking at spreadsheets, which are I think the whole world's trying to move from.
Yeah, I mean, that's a good analogy. And kind of like what Josh was getting at is that you almost need conversation starters and to show you being that knowledge broker. And, you can have those awkward kind of conversations. Not all the time as a real estate agent, if you want to rely on the real estate agent to start those conversations, because if you think about it, a real estate agent gets a new listing, that new seller client is going to become a borrower, right? Remember that stat, 7 out of 10 buyers are homeowners first. So to have a conversation now about, okay, what's your equity position? Different financial conversations so that they can make the handoff. It's a lot more challenging, especially in a remote world where a lot of these documents are signed. You don't even have to go to the house. So the importance of now using data, so taking the offline conversations, which are becoming less and less, and making more data driven. We're seeing this a lot with, you see these mortgage statements you get every month, but an equity statement is one way where you're delivering every month to your past clients or any other additional prospects. If you're almost doing like a financial analysis every year, every quarter, every month, however you want to do it. Obviously, technology can be automated, but instead of going, okay, well, let's log into your mortgage, your LLS system, and figure out what your current mortgage balance is, what rate you bought it at. Now let's go over here and find out today's rates. Okay, you've been in it 2 years. Let's see, you're still paying PMI, so we can walk down that conversation. That can all be automated. Like all that information I just described can all be pulled together in an automated fashion using that data to start conversations with the homeowner, who is that future borrower. And you could act as that knowledge broker. You just need the conversation to be started. So you need to have data and technology to physically almost move you to the other side of the table, as Josh was saying, and be looked at more as an advisor. So, okay, do you really honestly care that you're going to help them remove PMI so they can, but why are they wanting to do that? Well, they're looking to save money. Okay, how else can I help you save money? What are you looking to do? Is it putting somebody through college, one of your children through college? Do you need to pull money out of a HELOC? Do you need to refinance? Let's look at it. It's just a conversation starter. And I think with the digital way and with people used to getting sort of monthly updates of creating these sort of financial analysis and becoming that knowledge broker can really help, change the dynamic. There's that cringeworthy stat of, was it like 80% of people say they'll use that LO again? And when they actually go to do it, it's more like 12%. It's because people lose touch, and automating, leveraging all these data points can really help initiate conversations and kind of get the ball moving towards becoming that knowledge broker and that trusted advisor. So yeah, that's how we see data, especially the behavioral data now coming off it. You could send a paper home equity statement every month, but you really can't see the engagement of that consumer. Mm-hmm. Send it digitally, you can now see what things they're messing around with, and that feedback also can help the LO be more intelligible when they engage that homeowner. So lots of different opportunities as we move into this sort of one-click economy is one thing I like to call, is just leveraging the data to be much more intelligible in this market. So.
Nailed it.
Yeah, I think taking the data, especially as Charles was saying, especially now when half of the mortgaged home in the US is equity rich. So their LTV is less than 50%, which has never happened in the history. Not to mention 1/3 homes don't even have mortgages. So we are sitting at the highest level of equity that we have ever been. And that's, how do you use that equity? It's something that we haven't done well as real estate professionals to educate our homeowners on that. And that's something which I think what Charles is working on in terms of technology, to be able to first come up with that information. And then, of course, not just take that information, but convert that into knowledge. Is that, what does that mean for you in terms of sending your kids to tuition, sending your kids to college, or buying another home, or whatever the need might be? What does this equity translate for you, especially the kind of equity levels that we are seeing right now? That's just a huge amount of opportunity that the entire industry is sitting on.
Yeah, I agree with what both of you pointed out. Absolutely. And Charles, you hit on something that I thought was really interesting. There's a gentleman by the name of Vivek, and I can't remember his last name. It might be Kumar. He's the chief product officer at Property, I think it's called Property Genius out of Singapore. And he talks a lot about this thing called a use frequency spectrum. I know that's kind of a mouthful, but basically what Vivek is saying is, when a consumer uses a product quarterly or more often on this side of the spectrum, then the consumer gets into a habit of using that spectrum, using that product. In other words, I fly Delta. So when I go to look at a flight, I don't go online and go flights from Salt Lake City to Texas, right? I just go to my app because I use that app at least once a month. But the products that we use less frequently than quarterly, and the farther it gets on the other side of the spectrum, right? So, there's quarterly, there's annually, then there's decades and more, right? So the only product that's used less frequently than mortgage and real estate is like our mortician, right? They're yet to get a repeat customer. But the farther we are on this side of the use spectrum, the more value we have to create post-transaction. And it's exactly like Charles was saying. It's having something that you can give them of value that reminds them that you're the knowledge broker, whether that's a valuation of their home, whether that's reaching out to them about their tax notification, whether that's doing an annual loan review, an equity analysis. Like, we got to get good at bringing knowledge and the valuable thing that we bring to the consumer post-transaction should be knowledge. It shouldn't be with an intention to sell. It should be with an intention to help that consumer become more financially literate, make better decisions, and have all the information they need to make the best decision possible. If we do that as an industry, then we move from the frequency of transaction, which may be every 5 to 10 years, to the frequency of interaction. And we need to interact with value exchange and knowledge exchange way more frequently than we have as an industry. But the industry is in this, I think, process in many ways of moving from transactional to relational. And I think we have to leverage technology, but it has to be mixed with expertise. So Charles, I think you said that really well. I just wanted to put an explanation point on that because I 100% agree with you.
It's perfect. Thanks, Josh.
Yeah, buddy.
Going off of that, having that expert knowledge, I think, is something that we're seeing more and more, and something that's come up probably with each of you in all of our earlier calls is the inventory is low right now, right? But one of the things that we see is that the need for housing is still there. The people who are waiting for housing, that need will not diminish, right? So increasingly, we're seeing people across the industry, especially on the mortgage side, look at diversifying the product range that they're offering. So I think that's not been something that people have been particularly worried about in the past 2 years, because you haven't really been seeing the emphasis on purchases. So one of my questions, and my next question to all of you, would be, how important do you think that education piece of products is as we look at serving the future borrower? Shashank, let's start with you.
Yeah, I mean, in technology, we always hear something called product market fit, right? You need to create product that fits into market. And the other way around, if there is a market, you need to build a product that fits into that market. And that's something that that as an industry, I think we have done well in terms of creating products. I'm not sure if we've done an equally good job of letting our real estate, say, referral partners or the clients know about those products. We talked about the fact that half of mortgage homes are now equity rich, which means HELOCs have suddenly kind of the use of HELOCs have jumped through the roof. And is that something that we are focusing on? There are 10,000 people that turn 65 every day in the US. How much are we focused on, say, reverse mortgages? The fact that self-employed borrowers have had really tough last 2 years, and so using conventional method of qualifying them on averaging last 2 years tax returns is not going to work. So how many of us are doing non-QM loans based on, say, bank statement deposits that they might have this year? We did a special program called Trade-in Mortgage, where you don't have to sell your home before buying a home. That's just a special program that we do here. But really, what I'm trying to come to is that you were right, Alison. For the last 2 years, you didn't have to think about it, right? You could practically throw in every one of Fannie Freddie loan at 2.75%. Everybody qualifies, everybody wants it, and it's all good, right? Suddenly you are in this market where we have to make things happen, and product is one of the ways to do that. Coming up with the stuff that does not fit into the Fannie Freddie FHA VA bucket, so to say, which is what we are used to selling for such a long period of time, and trying to figure out a product, a way of making things happen. But it also starts from executive level itself, is that as a company, if you are the chief product officer, or if you're the chief executive officer, are you bringing that culture in where you're talking about the fact that, look, minorities are going to be the majority homeowner for the next 10, 20 years? Are you bringing in down payment assistance programs to assist them into something like that? That's something which we at the company, and I'm personally very, very passionate about, and something that we talk about a lot is the fact that it's a minority that will drive the home ownership over next 20 years. So if you're looking at building a company, if you're looking at building a business that will stay for the next 5, 10, 15 years, you need to look at some of those trends. And you may not be able to build product because you may not be at a size where you're not a Fannie Freddie, or you're not a company that can build products. But if the products already exist, can you train, coach, and mentor your team to be able to sell them and underwrite them and then process them, so that that's something that you can bring into the consumers? It will be great for you as a company. It will be great for those consumers that did not think those products existed. And it will be an amazing tool for you to be able to build those real estate agent referral partners that Josh was saying. Those are their problems that you're solving one way through offering these products that some of the other people might not be offering.
Yeah, I would add, Josh, I saw you just go off mute, so you're happy to jump in.
I'm happy to wait for you too. Do you want to go first?
No, just in terms of the education, I just think also with technology and helping educate borrowers, no matter even pre-borrowers, renters, even people that don't have access, don't have access to their own financial advisor. You know, Shashank just mentioned underserved too. It's just having this data, this information also can help educate no matter who. I mean, everybody's, what is it, you know, how many, 80% of America, whatever, or more has, you know, a mobile phone. They all have access to internet across the country. So bringing these financial tips and knowledge and advice to anyone who's got a mobile phone, whether you're a renter, whether you're a borrower, it certainly helps raise the bar of education. Yes, rates are high, but they're not historically high. They're not ridiculously high. So even if, you know, somebody borrows now, they, with the right tools, with the right education, they know they can refi that out at a later point in time. So how long can they bear the higher rate? So education married with, you know, marrying a loan officer or a real estate broker with the right tools and with the right knowledge and information really can help raise the bar with education in today's world, and make it much more accessible, make mortgages more accessible, make home ownership more accessible. So yeah, that would be my point. I mean, there's companies like, you know, FinLocker who's doing helping the underserved with first-time home buyers and turn down home buyers, and you know, just being able to do credit checks and restore credit, but bringing this education to the masses, no matter, there's no more obstacles, I think, with technology to help. So mic's to you, Josh.
I think that's really well said. And I love this question, Allison, because I think this takes us full circle, right? The beginning question was, what's the silver lining? And the silver lining of moments like this is that, you know, our pipelines aren't bustling so quickly that we have no time. You know, we're all running on 4 hours of sleep like we did in 2020. So now we have time to zoom out and take perspective and to see, like, what are the needs? And maybe that's a product like Shashank alluded to. Absolutely. There's places where we can have more creative product to solve challenges, whether it's a DSCR or a grant program or any of those types of things to an underserved communities. And also take the time to up our skills. As Charles was alluding to, you know, we have a huge initiative right now where we're trying to get everybody inside of our organization certified under the CMPS, Certified Mortgage Professional Specialist designation from Momentify. And our thought process is, why we have this lag time, why wouldn't we run our underwriters through that? Why wouldn't we run our processors through that? Why wouldn't we run our closers through that? I mean, the loan officers certainly should have it, but everybody should have that up leveling of knowledge, so that when they're making decisions for their own finances, when they're having a dialogue with a client, they pick up on opportunities that, hey, there's a gap in this client's financial plan that somebody needs to help lead them to a better financial outcome. I mean, the reality is we are not a financially literate culture by and large, which creates an insane opportunity for us as mortgage professionals. Because think about it, we have more data than anybody. I've got your credit report. I know the interest rate on all your loans. I know how much value you have in your home. I know your tax returns. I know how many kids you have. I know how old they are. I know everything. I arguably know more than the CPA or the financial advisor.
Or themselves.
What's that?
I said, or themselves.
That's right. That's exactly right. It's 100% right. And so we're the captain. We can be the captain of the wealth team. And an opportunity like this is, where can we up level our abilities to serve? And I think that's the silver lining that we are in right now.
One of the things I want to make sure we get to in this, that both you, Josh, and Shashank brought up in our earlier calls, was talking about the difference it makes in just being able to be a homeowner and what the net worth difference is between someone who's renting and somebody who owns a home. So I want to make sure we're able to go down that tangent a little bit, because I think it's really important when you talk about the education piece. So whichever one of you want to jump in first with that.
Yeah, this might be a bold statement, but really nothing builds more wealth in the US, other than maybe higher education, than homeownership. Nothing else.
Great point.
So if you were to look at, if I was running the country for example, and you had to do two things maybe to really improve the lives of the next generations, not just one here, homeownership will be one of those top two right there. When you're looking at an average net worth of about $7,000, $8,000, $9,000 for an average renter versus $184,000 for an average homeowner. That's 26x. And you keep doing that number for 2 or 3 or 4 generations. The reason why the Black homeownership is lower than what it was during 1950s, 1960s is because of the fact that we have not been able to build that generation wealth. One generation feeds into another. The huge part of building minority homeownership is you need to get the first generation into the home. Once you do that, then it becomes much easier for the second and the third generation to do that. Imagine being able to build that kind of generational wealth is starting with first generation. By the time you get to generation 3, you're talking being a millionaire just through that real estate net worth that we are talking about. And so it's really important from the perspective of just being the home ownership. That's why it becomes so critical, is with all the emotional benefit it comes with. And we know multiple stats, right? Chances of the kids going to college is much higher for a homeowner versus a renter. Chances of them ending up in some kind of crime or something is much lesser with that. Just the emotional The lifestyle is much better with owning a home. So there are tons of emotional and social benefit that comes with it, but just the financial benefit of changing a generation and the future generations' lives, nothing comes closer to home ownership. And that's why I think probably us, I mean, Josh and I sitting on this call and a lot of mortgage professionals who are really passionate about doing what they're doing is because they are not just helping them buy one home and giving them the benefits that it comes with it. In some cases, you're literally changing generations because of the fact that you're able to achieve it.
And isn't that cool? I mean, how cool is it that that's what we do? We're in the business of doing. Another stat that I recently saw from a Keeping Current Matters infographic they had is that in addition to the stats that you just laid out, Shashank, that 2/3 of all of the wealth in the United States is home equity. Isn't that crazy? I mean, that's just an amazing statistic. And imagine raising your hand and being like, I don't want to participate in that 2/3. I mean, come on, that's insane. So I think that, you know, the value of owning a home is everything from a family standpoint, right? Everything from a community standpoint, from a wealth building standpoint. But I think there's one more component. When I signed for my first mortgage, I got a huge lesson in adulthood. I started to read legal documents for the first time. I started to deal with a banker for the first time. I started to really look at my budget for the first time. And then a few years later, after I improved the home, I started looking at cash flow. I did my first cash flow analysis on my first home that I turned into a rental property. And then I did my first marketing project because I had to market that property. So the whole evolution, if you will, of education, of buying a home, maintaining a home, managing a home, like it's just a huge step forward in financial literacy. And if we add all those things up, it's incredibly valuable. The totality of that value and that education, as well as what it does for your family, is immeasurable, in my opinion.
I'll add, since you guys just challenged me to also throw out a stat. I'll go more on a micro level. By the time the average U.S. homeowner retires, 83% of their nest egg comes from their home equity. Wow. Not their 401k, not their Roth IRA. It's coming from home equity. So that in itself should tell every American citizen who does not have a home, yes, you can invest in stocks, and some people do extremely well. But the large percentage of your nest egg is going to be coming from your home equity. Now, what does that mean to the audience here today is how can you become that knowledge broker to help those homeowners leverage that home equity, whether it's for them themselves or their future generation, as Shashank mentioned. How can you use that in the best way? It's not just tapping into that equity by selling the home, and that's great for real estate and all, but there's other opportunities to tap into that equity and best leverage it. Who better to help you with that than your home wealth advisor or your trusted advisor, your loan officer, and your real estate. There's lots of educated real estate agents too that also have that financial background. So I think the wealth part of it is huge. Increasing financial home ownership literacy is a big mission that I'm personally on as well. And yeah, if we were president, Shashank, I'd be your vice president touting the same thing. So
I wasn't born in this country, so that disqualifies me. But
all right, I'll take it. We'll switch. That's not a job I ever would want, but yeah, that's so I think we're all on the same path there of the importance of home equity and what it could do for individuals and generations to come.
So the really interesting thing for me when I was even looking at planning this conversation was that came up at some point, and the really cool thing that also got brought up is the capacity, or there are instances that Shashank, Josh, and Charles even brought up about having that. The first step with that is getting people in the homes. That's step one.
Yes.
Getting people from the rental path into a home and having access to information, and also being able to work with your partners and saying, hi, this might have looked 2 years ago like you couldn't get this person in a house, but this is what we can do now. This is our middle ground. And one of the really interesting things that I spoke with Josh about was you told me you were talking to a realtor who had never heard the term seller concession. And I was like, how are we here?
I mean,
so I want to round things out in how you see this relationship and actionable steps where you see this work and how you've seen it work in your business practices. And Josh, I think I organically sort of turfed this football to you first.
I'm happy to answer it. I think coming off the last round of questions, just around how noble and important of work that we do is such a honor. And there are a lot of real estate professionals out there that got into the business in the last couple of years and maybe don't have the number of years under our belt. They haven't seen the wealth building potential, and they really don't have the knowledge that we have. You know, I've been doing a bunch of realtor presentations lately with my mortgage advisor partners, and two comments that I think I mentioned to you, Allison, really struck me. One of them was we were talking about a seller concession, and a realtor raised her hand and said, "What's a concession?" and I was just completely, I'm like, okay, I need to go back further towards the foundation here. Okay, I got it. And another one that was really funny was we were talking about buying out the mortgage insurance, because all of our conversations, and I think this is where you're going, is around making housing more affordable. How do we get those first-time home buyers into the market in spite of what seems like higher prices and higher interest rates? And so, you know, we were talking about these strategies of getting seller concessions, different buy down strategies, also using that money to buy out the mortgage insurance. And I had another realtor raise her head and say, "You can't buy out the mortgage insurance." She was like, you know, checking me. And I said, well, you kind of can. And so I think it's a time for us to get back out to the realtor community and start to really transfer that knowledge, be the knowledge broker, as Charles so eloquently said, and educate them on how do we make housing more affordable for first-time buyers or move-up buyers, without just pulling the lever of price reduction, because that's all the real estate community by and large knows how to do. Hey, a house isn't selling, what should we do? Pull the lever of price reduction. But there may be 5 other levers that we could pull, whether it be product, whether it be loan structure, whether it be buy down, mortgage insurance reduction. How about buying a property with an ADU and partnering with your parents and having them and rent out part of the ADU? Like, there's a lot of things we can do other than just pull the lever of price reduction. And I think it's incumbent on us to get out there and be that knowledge broker, like Charles said.
I've got nothing to add. Josh nailed it.
And I think the interesting thing is now there's a lot of tech that exists to bridge that gap or serve as like a starting point, right? So my next question is, how do you see tech helping the consumer from like an initial standpoint? Charles, let's start with you.
Excuse me. So, yeah, I mean, we mentioned a little bit earlier, but tech could essentially, you hear AI a lot, right? And I don't look at it as artificial intelligence. I look at it as augmented intelligence. It's really helping augment the loan officer, augment the real estate broker, and bringing some of their knowledge, not all of it, that's nearly impossible, but some of it to the living rooms or the mobile phones of the homeowner. And we obviously do that at Percy, but there's lots of opportunities there to bring technology into the living rooms of the consumer in a very relevant fashion. The panel today mentioned all the different technologies that are out there that the consumer engages with during the process, whether it's on the real estate side. There's the Zillow and the portals and the brokerage websites. There's the open house applications they can sign into. There's showing reservation appointments. Then they're making applications on a whole different platform. They're saving their searches. They're inquiring on properties. So they're on all these different platforms, and all that data does exist, and it all can be boiled up in a very relevant fashion, and bring this information to the consumer so that they don't have to go to 15 different places to try to figure things out. So I think kind of harmonizing a lot of the data and a lot of the intelligence in such a way that that we're bringing the LO or the real estate agent almost behind the consumer. So as they're in the living room, as they're searching for the home equity on their home, or looking at their equity statement or what have you, it's almost like the LO or the loan officer or the mortgage or the real estate is sitting behind them in such a way for that engagement to happen. So that's really how I see technology is really bringing all those disparate data points from all different platforms, making it a much more convenient, easy process from beginning the just search to the actual loan application itself, which largely can be pre-populated with all the data that has already happened. So just bringing the convenience and ease of use and access, that much more improvement that can be had, in my view, in our view, to the consumer.
I mean, there are two components of technology. One is, of course, the pre-sale, right? It's when people are thinking about buying a home. And that's where I think technology can play a huge role with something like that, is because you're sitting, I don't know, at 10 p.m. and then thinking, hey, we should be buying a home. And you can't really call a loan officer at 10 p.m. So you're like, okay, how? And then one of the first questions that come to mind is, how much do we qualify? Right. I mean, people usually make the mistake of jumping on Zillow or Redfin and trying to see all the shiny homes around themselves. The first thing they should, or in their head at least, goes like, do we qualify for these homes? And that's where I think technology can play a huge role. That we, with our first digital human in the industry that we built, Rachel, a year and a half back, which is a conversational artificial intelligence platform, we are developing a 2-minute pre-qualification where it's not a full pre-approval. It's not where we ask for tax returns and W-2s and everything, but it's for those people who are sitting there at 10 p.m. thinking, how much do we qualify? And I'm willing to give some ballpark numbers right now, but can we at least know, do we qualify for a $300,000 home? That's the first hurdle, so to say. You can, of course, wake up in the morning, and if all the numbers look fine, you can still send your pay stubs and W-2s for a comprehensive pre-approval. That's one of the hurdles that we can handle through technology. My philosophy with technology always has been, and that's what we're working on, is that let humans handle the high impact jobs. Let humans handle empathy. Let humans handle consultation. Let humans handle escalation. They don't have to come up with a debt to income ratio. The technology can do that. If you tell me you make $10,000 and you have zero debts, I know I can give you a mortgage for $4,500. I really don't need a loan officer for them to figure that out. Similarly, with backend, one of the biggest problems that we have had with the entire consumer experience within the mortgage industry is that we have fixed the point of sale problem, which is, as Charles was saying, you can upload the documents and you can complete the application online on the app. All of that has been super easy. But the reason our turn times have stayed between 35 and 52 days over the last 2 decades is because we have done nothing to solve our day 2 to day 30 problem. We have solved the day 1 problem of point of sale. We have not done anything to do that. And that ends with a consumer experience, which is sometimes so bad that even if they can refinance and save money, they don't. Every quarter, Black Knight comes up with the data that potentially 5 million people can save a ton of money on their refinance, but they don't. You know why? Because the last process was so painful. And that's something, again, the automation technology can help. There are tons of tasks that processors and underwriters and drawers and funders do right now, which we can automate, do 50, 60% of the job through a fully automated platform. And then let the humans do what they're really good at. With 10 years of processing experience, you don't need to order flood search. Someone else can do, a bot can do that. And that's what we do. I mean, our bots order some of those flood search. But I see an opportunity for technology and AI or intelligence automation, both to play a role in the front end in terms of helping them get over that first hurdle of how much do I qualify, and then improving the experience in the back end so that they want to keep coming back to this process over and over again.
You have time for me to answer, Allison?
Yes, I want to make sure we get you to answer before we wrap up.
All right, thanks. So I have a I have a personal mission inside the mortgage industry that I want to create stronger and better communities by providing and spreading and teaching financial literacy to families across the United States. And imagine a world where when a consumer came to you, you use technology to show them different mortgage strategies and different paths. And not only, what that decision would have ramifications in their monthly payment, but what potential ramifications that could have in 30 years. And you help them decide on the right mortgage strategy through a use of a mix of consultation and technology to deliver that information in a way that you could get a consumer to think beyond their limited ability. People think pretty good in terms of months and maybe even years, but people think horribly in terms of decades and where they want to end up in 30 or 40 years. So if we could help them make better mortgage decisions and pick better strategies on the way in, but then imagine if for the next 30 years, we were more valuable to them than we were for the 30 days while they were under contract. Because we knew when their kids went off to college and there was a financial ramification. We knew that when their restricted stock options just became unrestricted and they had all of this wealth to redeploy. We knew when their equity came to 80% loan to value and they could refinance. We knew that they were behind in their retirement planning or had no retirement plan at all and hadn't been doing any things they needed to plan ahead. If we could leverage technology to notify us when it was time to step back into that consumer's lives, and we just magically show up and said, Allison, checking in on you. Holy cow, have you seen where your house value has been? You don't need to water your foundation anymore. You can hire somebody to do that. But let's talk about how you're going to leverage this wealth and how we're going to make sure that you hit your financial goals. So for me, what I'm most interested in as it relates to technology is to have insights into what's happening in the lives of my customers. So I know my team knows that they should step back into Allison's life and they should present some optionality as to what to do with their home, maybe make an introduction to a financial advisor. By the way, did you ever get that life insurance policy we talked about when you bought your home? Those types of conversations need automation and need technology, or we can never really transfer that knowledge, because 30 days is not enough time to transfer knowledge. I need decades with clients to help make sure they're on the right path.
Charles, I see you nodding. Anything you want to jump in with before we wrap up?
No, I mean, everybody hit it. I think just, there's so much data and so much information out there. It's distilling all that down. And, we've done a lot of that for whether it's telecom or mortgage or anybody else around that. The homeowner is so important in trying to understand where they are and make their life that much easier, where people just say, wow, it just so happens I am looking for a mortgage. How did you know that? Wow, it just so happens I am moving and need to switch over my internet service. How did you know that? Well, there's so much of these signals and this intelligence and information out there that can help. Creepy is no more a thing, almost like you kind of expect it and you want it to be one-click service. And so the better, this market is for this is to become more efficient, leveraging the data to make a much more elegant consumer experience, leading to more purchase transactions, leading to happier real estate partnerships. I think it's all goodness that, like I said, there's always a silver lining, especially for us. So really appreciate the opportunity here today.
And that was nicer of a bow than I could have put on it. So with that, we are at the top of our hour. Charles, Josh, Shashank, thank you so much for joining us today. And to our audience, thank you for listening. This recording of this Lunch and Learn will be on HousingWire's website, and it will be shareable in a few days. It also will be sent out to all of the people who registered. Thank you all for joining us. Hopefully we'll see you all again soon.